there is a permanent distortion between financial markets and real assets or real growth. And what that indicates is that there's been so many years of quantitative easing and so many years of cheap rates that even though we had this period, and it is the longest period in the last 24 years of rates being this high for this long, it wasn't enough to really shake out the money that was on the side, the money that could be leveraged, the larger institutions or banks that had the ability to get money at lower levels and consumers and so forth, and they did.
This week is marked by a divergence of central bank policies. The Federal Reserve in the U.S. has kept rates unchanged. The Bank of Japan raised rates for the first time in 17 years, while the Bank of England cut rates for the first time in 4 years. So this confluence of divergences, what does this mean for the global economy, interest rates, and real assets? Joining us today is Nomi Prins, geo-analyst, and we'll be talking about her outlook on the economy as well as her outlook for the metals. Welcome back to the show, Nomi.
Thank you so much, David. Great to be back. Lots going on.
Absolutely. You were on the show a couple months ago. I encourage people to check out that interview. We're talking about risks to the economy, risks to the labor force. We can revisit some of those risks. But going back to what I believe is probably the major headlines for this week, central bank policies. So like I said in the introduction, a divergence of different policies. Why do you think there's such a different change of attitudes or differences in attitudes between the major central banks around the world right now?
Because they've decided to really focus on their own economies. And by that, I mean what's going on with their own labor markets, what's going on with their supply chains and needs, and looking at the evolution of those to come, and also their own inflation pressures or not. So in the case of the UK, it was interesting because, yes, they did cut rates, and they also had quite a shift in their last election with the Labour Party winning substantively over the Conservative Party, and then coming in and saying they were actually going to cut parts of the budget, which you typically see as something that's occurring with the Conservatives, and that's because the debt is so high. So it's interesting that they're basically looking at an approach of reduce rates, also try to reduce debt, and try to actually balance the economy where the debt to GDP is very high. In the U.S., there is still that Powell stubbornness, I think, attached to trying to be the superhero of inflation fighting, and occasionally saying that the labor market should be cooler as he did. The labor market unemployment rate's gone up to 4.1%. We haven't seen those rates since before COVID, not including COVID, where obviously the economy was closed and we saw some major spikes. So it has been creeping up. There are people in particularly rural sectors and some of the manufacturing areas and some of the swing states as we look toward the election that are actually not doing quite as well as even the figures for additional jobs might indicate. So there's definitely cooling there. And that's one of the reasons why I think the Fed will actually reduce rates in September. He's still trying to get actually inflation down, but also the economy is slowing. We did see a 2.8% GDP print, but before that we saw a 1.6 rise down to 1.3% GDP print. Our economy actually is sluggish, and adjusted for inflation is actually flat to declining. So the U.S. has to really take care of its own. And Japan, after years, decades, and it still has negative rates. So the fact that it's raising its rates from negative to slightly less negative doesn't do that much, except kind of indicates that they feel more secure with their inflation picture. But it is interesting, this divergence, because what we saw in the financial crisis of 2008 was so much collusion. I mean, I wrote a book on that years later because it kept happening. Central banks doing what all the other central banks were doing. What we are seeing is less of that, and we're going to continue to see less of that unless we have major banking crises pop up on a domestic and potentially global scale.
When you say there was more collusion before versus now, what were the major changes or differences between their attitudes before and now?
So in the wake of the financial crisis of 2008, the big issue was getting liquidity around the world because the banking system and the financial system in the United States had effectively collapsed. And that had knock-on effects to major institutions in Europe, to major institutions in Asia, and so forth. And so there was a real need to pump dollars throughout the country and keep that liquidity, the country and the world, to keep that liquidity going. There was a real need for quantitative easing. And then there was a double downing of that need in the wake of the COVID crisis. So we saw through this entire period that central banks were predominantly acting lockstep, more or less, with respect to their monetary policy, with respect to rates and to a lesser extent, but still with respect to quantitative easing. Of course, countries that are not major players in the world can't do as much quantitative easing. It just doesn't work for their currencies. But as a general matter, but now what we're seeing is in the wake of inflation being lingering, even though it has come down domestically and throughout the world, the reality is things, supply chains, transportation, logistics, geopolitical factors are all going to keep inflation on a relatively higher footing than it was before any of that period. And so that's the reason why countries really do have to pay more attention and why that divergence has happened to their own economies in terms of how their own monetary policies impact their own economies by more so. And of course, we've also seen a divergence from some dollar holdings in a lot of central banks around the world, buying of gold and so forth that sort of continue that divergence theme.
When you say that you're expecting the unemployment rate to rise, can you comment more, elaborate on your thoughts here? How significant could this deterioration be throughout this year, and what would you attribute this deterioration to?
Well, it's the fact that when you look at just the aggregate unemployment figures, they are in fact aggregate. But if you look at the pockets, what we're seeing is more of the additional unemployment rate rising in some of the smaller communities, some of the local communities, and some of the states that typically have more manufacturing jobs attached to them. So not like the government jobs, but actually manufacturing and other forms of jobs. And so that the complexion of the payroll figures has to take that into account. It takes longer to filter in. It's more data to aggregate across a more sort of expansive set of localities. And so I think that when we start to see some of that accumulating, we've already seen that trend. We've gone from 3.9 to 4 to 4.1% unemployment pretty quickly. That shows a momentum in the rate, which is what it is, indicator of unemployment, which is trending in that sort of upward direction.
Can we talk about some of the preferred assets that you have in mind currently? Just asset allocation strategy based on what's going on in the world, and we can dive a bit deeper.
Yeah, so I mean, there's the obvious one, which is gold. We've hit about 2,500 on gold. I mean, I've talked about it getting to this level a number of months ago, or actually last year, that it would get to the mid 2,400 range. It has. I think it's going to go towards the 3,000 range as we get through the election period, because it typically, when we have a ton of factors sort of impacting gold, which include central bank buying, which include retail buying, which include retail throughout the world buying. Actually, the Chinese, for example, ETFs and gold have had their record after record months of inflows that doesn't even really get reported as much as the central bank buying of gold. So you just have a lot of momentum around that metal relative to dollar diversification, wealth diversification, and just a general uncertainty factor in terms of geopolitical events and financial events. Silver is the sort of next cousin of gold. Now, silver actually outperformed gold during this year period and also year to date period, almost by double. Of course, its miners have underperformed the metal as they have in gold, but from the standpoint of the physical precious metal itself. And silver has a use value. And that use value in terms of conductivity, in terms of energy transformation, is not going away, because we are seeing growth in these areas throughout the world. And we are seeing political policy, actually on all sides of the spectrum, continue to embrace energy efficiency, whatever you call it. And energy efficiency relies on good conductivity, which relies on silver. And we still have mines at depleted supply levels post-COVID than we had before. So there's a lot of catch up to go on there. In terms of uranium, it's one of the things I talk about a lot. That outperformed gold and silver and copper over this year and over this year-to-date period. Why? Because it has support both globally and across political spectrums globally, and particularly in the United States for domestic supply of uranium and allied supply of uranium to continue to grow to get to those 2050 tripling of nuclear energy trends, but also the technology of nuclear has gotten a lot of bump from three bipartisan acts that have passed this year. One before this year in the NDAA, the National Defense Authorization Act. We've had the Russian ban Russian uranium act that has passed. We've had something called the Advance Act that's passed that focuses on the technology aspects of making nuclear more efficiency, safer, and less wasteful. And we've had the Nuclear Fuel Security Act. So we've had with the dysfunction that Congress is at any point in time, and the partisanship, we have had a significant number of bipartisan acts pass which support the policy, the pivot, the investments in uranium and uranium technology and nuclear energy, not just in the United States but around the world. So that's a place that I continue to see that coalescing. And then the new place of coalescing, and I think this will happen after the election, but is starting in Washington, is to do the same with critical and rare earth elements, is to look at allied elements and to look at domestic supply there and support the technology of unearthing that supply, processing that supply. There are plants that are opening up and being built right now in the United States to do that, to just rebalance the world in terms of that supply chain. So these are all longer term, been staying with us for quite some time, geopolitical, cross-party, and supply chain and energy related trends.
Before we continue with the video, I want to tell you about one of the best performing assets this year, gold. The price of gold keeps rising. It's no mystery why. The Chinese central bank is stockpiling gold in the face of deglobalization, while Chinese citizens are buying gold hand over fist to protect their wealth amidst a real estate crisis, a stock market going nowhere, and low interest rates, all seismic shifts for a country that enjoyed immense growth for 20 years. These forces are here to stay, and they're strong. They've created such momentum that gold is now attracting interest from Western investors. The chart is bullish, the arguments are many, and the move is still young. When gold rises, companies putting new gold mines into production usually rise the most. It's called leverage. West Red Lake Gold Mines, today's sponsor, is one of the few Canadian gold stocks putting a gold mine into production in this exciting gold market. The Matson Gold Mine is largely built, and West Red Lake Gold knows exactly what it needs to do and when to achieve its goal of getting this high-grade gold mine back in operation in 2025. West Red Lake Gold is a stock made for this gold market. Learn more in the link down below or scan this QR code here. Okay, I want to turn to your recently launched Substack. Congratulations. People should check that out. Link below. Now, you wrote a piece recently called "Is the Fed Irrelevant Now?" Question mark. And it's very interesting. You're basically making the narrative that the central bank policy rate has been high for so long, yet markets reacted the way they have on the expectation that eventually things would change. This is a paragraph that I like to draw your attention, the viewers' attention to. Stock markets don't care about debt or interim monetary policy noise, except when the Fed endows them with cheap money to hoard. Investing uses betting chips on a speculation board. You wrote also that the Dow, NASDAQ, and S&P 500 cruised to record highs despite the Fed raising rates from March 2022 to July 2023. That's a great point. Why did the stock markets go up even when it seemed like monetary policy was tightening?
Right. The logic is monetary policy was tightening. It was supposedly higher to reduce inflation, but it does make money more expensive to get. So the fact that money was still in the markets, that equities still rose, despite all of that, despite the sort of let's focus on inflation, but let's ignore inflation in the stock market, is just an interesting phenomenon that I think is based on no matter what happened with rate hikes or the focus on them, there is a permanent distortion between financial markets and real assets or real growth. And what that indicates is that there's been so many years of quantitative easing and so many years of cheap rates that even though we had this period, and it is the longest period in the last 24 years of rates being this high for this long, it wasn't enough to really shake out the money that was on the side, the money that could be leveraged, the larger institutions or banks that had the ability to get money at lower levels and consumers and so forth, and they did, and it went into the market. And then you add on to that the expectation that rates will be cut at some point and money will be even cheaper at some point, and why not use it now? And that is what we are seeing. So if you zoom out of this period of each FOMC meeting talking about what's going to happen with rates, what's the market doing today? The market rallied a lot after the FOMC meeting on Wednesday. It declined a lot today on Thursday. It overall balances out to an uptrend. And one of the interesting things I said in this piece, I look back to June 1999. before all of this very, very low interest rate policy came, and even before QE became a big thing. And there was a book that came out that said the Dow would Dow at 40,000. And at the time, the Dow was at 10,000. This was in mid June 1999. It did eventually get to 40,000, not when the author Elias said it would. He said it would be in 2016, a little bit later, but this year, this May. And on that token, and that was somewhat boosted by quantitative easing and low rates for a long time, but we're in that environment. That's not going to change. If we have a banking crisis or a major situation with liquidity, that QE will rise again. Those rates will go down more significantly, more quickly again. That's the environment that we are in, despite having had inflation pressures, and despite the fact that we're going to continue to see lingering inflation going forward, because that's just where we're at geopolitically and from a supply chain perspective. So by that token, the Dow could actually get to 160,000 by 2050, which is a long time out and a big number. But these factors all override these interim moments right now
And
of
by the way, if the Dow goes to 126,000, what's going to happen to gold?
yeah, 160. Yeah, I mean, and yeah. So if we look at the Dow, if we look at the fact that the Dow,
Yeah.
just even over this period, has basically appreciated by so much since COVID, and even again since the Fed's been raising rates, and gold's appreciated by about 30%. You're talking about gold,
Yeah.
also quadrupling from those
Sure.
levels or more.
Sure.
Yeah.
Uh, so basically short term then, where I guess even in the medium term, your outlook for equities is it bullish?
Medium term, yes. I mean, we can have short term volatility, but medium and it's longer term, yes, because all these mechanisms are in place, and we've seen even again some of the tightening that's happened hasn't really reduced the flow of money into equities, and they have the tools to increase liquidity if it's necessary and more acutely necessary.
But would you say economic growth is reflective of this bullish sentiment in equities?
It's not. I mean, this is the whole thing, and this is what we've seen. If you look at this, is how I opened up my book, Permanent Distortion. If you literally look at GDP growth, like the change in GDP growth for the most part in the United States for decades, really, but certainly the century, it's kind of a flat line between -2 and +2%. It really kind of hovers around zero. But the equity market just does, it just literally has no relationship to that. The equity market's done what the equity market has done.
You have a paragraph here in your Substack. What about economic growth? In the second quarter, U.S. GDP jumped by 2.8% and beating the consensus estimate of 2%. This news was primarily viewed as a win for the U.S. economy, but all that glitters is not gold. There were red flags beneath the surface of the GDP figure. Tell us about these red flags, Nomi.
So most of that growth was attributed to, by the BA, was attributed to personal consumption. And if you look at personal consumption deeper, the savings rate has continued to decline, and the amount of savings that the average family has continued to, I'm sorry, yeah, the savings rate has declined, and the amount that they actually have in savings has also declined. Whereas the debt and the cost of debt and the interest rates for that debt has increased. So what you have is a shrinkage of available money, a shrinkage of the availability of saving money, and then you have an increase in people buying on debt, and an increase in the cost of that debt, and an increase in the total amount of debt. So you have two diametrically opposed factors that underlie personal consumption, and they add up to people don't have enough money to continue to buy what they buy. And so if that's what's driving in a particular mini cycle GDP, and that's the significant driver, the last one, that is not sustainable.
Generally speaking, how concerned are you for the average American consumer in terms of either A, their purchasing power, and B, their job security? We'll break it down into two parts.
So purchasing power has declined. It has declined because the value of the dollar, so for the United States citizens in particular, and it has also declined because of this lingering inflation. We have seen prices rise less quickly more recently, but they are still rising, and they are still rising more quickly than average wages have kept up. And by that same token, in again, some of the smaller towns and localities and manufacturing belts, jobs are harder to come by. And you throw actually AI into that, and I know this because I've been talking with a number of labor unions who are very concerned about this issue, and there's significant concerns coming in about being replaced by AI. It's a separate conversation. AI is good in a lot of ways, but in this way, it is creating more insecurity in the job force. So I do see the average American worker, a lot of stress from the standpoint of paying for things, lingering inflation and job security.
You've also highlighted in your report that according to the BEA, the total U.S. personal savings fell to $720 billion from $773 billion, or 3.5% from the 3.8% personal savings rate. A slight decline. Is this a material difference, do you think, Nomi?
It isn't a huge difference, but yes, it is material. And it's material because it's showing a trend in that direction. At the same time, as we were talking about a bit earlier, the trend of using debt and paying for that debt more has increased. So in isolation, all things equal, if it was just one quarter and or 1 month of data, maybe not such a big deal. But if it's trending in that direction, which it is, and if on the other side we have a trend of debt accumulation and cost, which there is, then it is a worry.
Where is the savings going? One way to interpret this is that people are spending money, which is good for the economy. Is that the correct interpretation?
Well, again, that was part of that bump in that 2.8%, and when we have that component, but the thing is, people spending money and getting to sort of a barrier where they're buying more on debt, and that savings is going into servicing that debt, which basically is what's happening. That becomes at some point unsustainable. If the economy grows, if job growth is more solid, if wages really increase, and if inflation really were to come down, i.e. prices come down, not even the rate, that's a different story. But none of those things are what's happening. So I am concerned about all of these patterns.
It was discussed by an economist on my show that even today, one of the primary concerns for American consumers is still inflation, despite the fact that the inflation rate has been coming down from 9.1% all the way down to now 3.1% headline, 2.6 core PCE. Should inflation still be a concern, a primary concern going forward, you think?
That's a really great question. I have a number of people who've asked me this question, and I think with inflation, this is my new thought on inflation, that people believe inflation and the economy to be somewhat conflated when they're asked the question. So inflation to people in surveys, most of them means, are things more expensive? They don't think, well, is the rate of inflation slowing? Are things getting more expensive more slowly? What they feel is this just like dull, constant burn of higher prices and trying to make ends meet on mortgages that are double the cost of what they were, on rents that have continued to escalate, on house prices that have continued to escalate, even though they've come down a little bit, they're still on an upward pattern. We're looking at a summer where gas prices are now starting to escalate again, as happens every summer. But these are all things that pinch individuals, grocery prices, all of these things combined. And then you throw on top of that credit card debt, which has been used to finance some of it, and which is more expensive now than it has been in effectively 2 decades. And so for a lot of generations at this point that are commingled, these are what I think people all attach to when they say, yes, inflation is a concern. What they mean is things are really expensive and I am really struggling.
It's expensive, but it's been expensive for a while. And I think even in the comments, people get this concept confusion. Inflation is the rate of change of prices.
Yeah.
It's not, inflation isn't down because the prices of things are down.
Right.
People say, I see this all the time. Inflation
Yes.
is not down. My prices are still high. Yeah, but
And
my point
yes.
is, yeah, when can we see, if, I'm not saying it's going to happen, but if it happens, when can we see deflation across most goods? Is that in the cards for you, Nomi?
I don't see deflation across most goods. I mean, will there be competition in certain like big sales items, by the larger companies in order to get more aggressive with consumers that are tapping out, yeah, maybe, and you could see sort of periodic slowdowns or cuts in prices of goods. But in general, companies are facing the same situation, which they're trying to make money. They are passing some of those expenses on. There are supply chain and transportation logistics expenses that they have that they do pass on. It's a cycle where to really see deflation, we would have to go back to real depression times, and that's just not a thing. And so that's why what you were just saying, that people are just whether you call it the rate of change or whatever, to them inflation just means high prices. That's and yeah, they've been here for a while, and yeah, they're going to stay, and yeah, it's oppressive.
Well, do you think wages can catch up to high prices?
On an average, they did for like a minute. That was where Powell was really sort of sticking his analysis to see wages have gone up and inflation have gone up. So we need to like suppress wages to suppress inflation, which was totally, misdirected. So I don't see overall wages increasing to the extent that they're outpacing what the average family pays for, sort of average goods for a week or a month.
Well, let's just take a look at the data here. The Atlanta Fed Wage Tracker in October 2023, about 5.2% average annual growth. The latest data point is of March, 4.7%. The graph has just been trending down ever since its
Accelerating,
peak
yeah.
in 2022. This broadly follows the trend in decelerating inflation, but it's still worrying because people want to see that growth rate maintained in their wage growth and
That's right.
not the other way around, right?
Right.
Is there any way that either policymakers or industry can turn this around? Is this up to the government at all?
This is an interesting question as well, because David, I don't know if you and your viewers know, but I've been involved in a coalition for a national infrastructure bank. And what would that do? It's a long story. We can go into another time, but effectively that would repurpose some of our current debt. So not issue new debt, no new taxes, no budgetary squabbles in Washington on either side of the aisle, into areas that require infrastructure development throughout the country. That's in power lines, that's communication lines, that's ports, that's bridges, that's road, and effectively create a non-inflationary finance mechanism which would allow for real development and real growth in our supply chain, in our manufacturing, and for people that get involved in the jobs and retraining for those jobs, as well as cybersecurity, so the technological side of those jobs and everything else. So I think that however you get at it, not increasing debt, being very mindful of that, whether it's an individual or certainly government, and focusing on growth and focusing on sort of strategic development and investment in infrastructure, energy transformation, and so forth, is a way to allow the economy to outpace the debt, which ostensibly will level the sort of field between the cost of things and the economic growth on the other side of that without necessarily causing more inflation.
How does that affect wages?
Well, because if there's more projects that are being seeded by, again, a non-budget, non-debt, non-tax oriented financing mechanism, then those projects will require more jobs and they will require more skilled jobs, and that will require attracting and keeping better and more skilled labor, and that will require a natural increase in wages.
Speaking of debt, the U.S. national debt just surpassed $35 trillion last month. That made headlines. What's your reaction to this figure?
It's insane. I mean, right? We are trading at a debt to GDP ratio that is basically never been surpassed, except sort of in the World War II era where we had a specific World War going on, and part of that is because there hasn't been this attention paid to where that debt is going. And this is why I was just saying before, we do really need the people in charge of policy that is impacted by being drained by this debt, right? I mean, you can't even open the lights in the United States right now without paying $880 billion a year. And that figure over the next decade is supposed to accumulate to $12.7 trillion of interest rate payments on the debt. Individuals know this. If you got to pay all of your sort of minimum credit card balance that's mostly made out of interest payments, that's harsh. You can't buy anything else. You got to service your debt first. That's the state the United States is in. That is just not okay for a leading economy or any economy. We are one of the leaders taking out Japan of debt versus GDP. We can do it. People buy our debt. But all the central banks, for example, that have bought our debt in the past, as a percentage, are buying much less of it, and on an absolute basis are buying less of it. So we are stuck before doing anything else in this country with a tremendous interest rate payment bill. That's not okay.
Do you think the Fed funds rate coming down slightly later this year would help alleviate some of the pressure on the Treasury to pay it's now a $1.1 trillion interest rate
So
payment
yeah.
bill every single year? Yeah.
Yep. I mean, yeah, it's going to make some of it cheaper. It's not, we've had a tremendous amount of debt that accumulated in the sort of post-COVID. We had a lot of debt to begin with, but a substantive bump in debt happened since COVID. So all of that debt, and especially since March of 2022, has been increasingly more expensive. So yeah, if you decrease some of the expense of the new debt, because the interest rates would go into effect for the new debt, so we would go above the 35 trillion. But the incremental added debt would, yes, be connected to lower interest rate payments. But I mean, it's a mess.
Let's move on to we'll finish off with geopolitics now. You analyze geopolitical trends quite closely. This came in from Reuters, or not Reuters, Financial Times a couple of days ago. The Italian Prime Minister Giorgia Meloni has pledged to relaunch Italy's relations with China at the start of an official visit to the country that follows her dramatic decision last year to pull out of Beijing's Belt and Road Initiative. That's a 180 in 1 year. Meloni met China's Premier Li Qiang on Sunday at the start of a 5-day trip that she said was a demonstration of the will to begin a new phase to relaunch our bilateral cooperation. Um, what's
What's
going
up?
on there? Yeah, what's the bigger picture here?
What's up with that? Oddly, it's another element of geopolitical diversification. We started talking about that with central banks, and everyone's sort of doing their own thing and accumulating reserves in gold and so forth, and not doing rates lockstep. This is that. From a trade perspective, these are nations that are looking at China as a major superpower, which it is, as a major initiator of projects. And we're just talking about development projects. China has several development banks that are used within the country and in conjunction with other countries to develop sort of energy transformation technologies, platforms, communications, security, and so forth. So other countries are looking for partners that aren't the United States. It's a natural evolution of sort of picking your sides in globalization to sort of picking your sides in more of a global fragmentation. And that's really what's going on now. We're seeing just more superpower locuses between the United States and China develop. And that's what Italy's doing. A country like Brazil, for example, and I spend a lot of time in Brazil. I study a lot of those dynamics between the US and China. That's a major economy that's in the middle of China and the US, and it has a lot of natural resources. And China wants to manufacture there because their energy is cheap. They want to sell natural resources to China. They also want to sell them to the United States. So therefore, it becomes incumbent on the United States to say, all right, well, how will we readdress these trade realignments? So this is the start of a major trend of realignments from a trade basis, not new, but revisiting as is this one, to see where the better, for lack of a better term, deal is.
Yeah, I think you're right. This came in later in the article. Obviously, we cannot hide the problem of a major imbalance with an important deficit for Italy. The prime minister told executives of the forum, citing the need for improved access to the Chinese market and stronger protection for intellectual property. My question is, Nomi, can we start to see over the coming years a shift in the alliance or allegiance of the European Union away from America?
I think we see more of this, which is that they try to play both sides. They do what Brazil has been doing, which is
Yeah,
basically try to have as good a deal with they as they can with both the partners, with the United States. Which it's not like Italy's going to stop trading with the United States. The
sure.
idea is that they have that independence. Again, going back to the central bank diversification independence, to be able to make um, that sort of individual country assessment in terms of where they do what and where their trade relationships are. I do think we are in a very kind of fascinating and evolving period right now where that's going to happen more and more globally.
Do you ever see a scenario in which the European Union would have to break up, perhaps their monetary policies within individual member states would be so dramatically different in their needs that it would no longer make sense to have a union?
It's a possibility. I think they spent so much time trying to become a union, and it's more of an economic trade union really than a political union anyway, or even a monetary union because there's still imbalances amongst those countries. I don't really see them fragmenting, but you will see scenarios like this where countries can still remain in the EU, abide by all the regulations of the EU, have the comfort of the EU trade pact and monetary policy pacts, and also look for relationships for certain sectors or products or services or supply chains outside.
And finally, trade relations between the U.S. and China. How do you see that progressing with the new administration?
I think whoever is in office next is going to have a very similar policy towards China. Just the degrees will be different, which is that we already saw the Trump administration obviously take last one take a lot of tariffs higher with respect to China and IP type conversations, more stringent and so forth. The Biden administration increased those. They brought EV tariffs from 25% to 100%, 200% in some cases they're looking at. They brought permanent magnets, which are intrinsic to our defense, our satellites and those sorts of systems from 0% to 25%. They're looking at more domestic supply chain concerns outside of China. That's all going to continue regardless of who is in office. It's like I was saying before in terms of nuclear. That was a bipartisan set of conversations that happened very quickly, actually, and off the radar in Washington to lock down domestic supply in uranium. Similar thing is happening with rare earths because of permanent magnets and how that impacts our defense. And I think that is something that's going to be consistent with respect to China and diversifying away from their control over our supply chain, regardless of who wins the White House in November.
Appreciate your thoughts, Nomi. Tell us where we can learn more from you. You have every time I talk to you, you've got something new in the works.
I appreciate you asking. Yes, I just launched a month ago a Substack, fully independent, great analysis in terms of some team that I have involved across the world, and it covers everything. We cover everything on real assets, one-on-one interviews, boots on the ground. Research. I'm going to be out at the DNC talking to folks about these infrastructure plans and real growth. I'm taking people with me through the Substack, not physically, but that's the type of material that'll be on there. It's called Prinsights. Pulse is the product. Prinsights Pulse Premium is the one where there's more boots on the ground content, and I'm really excited about it because it allows me to sort of take everything I've done elsewhere and everywhere into one new platform. So super excited about this.
Perfect. Well, I appreciate it. Everyone should check out Nomi. Links down below. So we'll speak again next time. Enjoy the rest of the weekend.
Thank you. Take care, David. Thank you so much.
And thank you for watching. Don't forget to like and subscribe.